gentlemen, good evening. Thank you very much for being here. Thank you to Magnus for the invitation. And thank you to you for the trust that you've placed in me in managing your overseas money. My task tonight is appreciably easier. I've got a presentation filled with good news and good stories. Lift the spirits up a little bit. And what I thought we would cover tonight is, as I haven't had the opportunity to introduce the fund to many of you for some time, we're just going to go through a performance review and get a little few highlights as to what has been influencing the performance of your fund. And then I thought we would do a little bit of a deep dive into how we manage the money on your behalf. The investment industry is full of many, many marketing spiels. I've been a fund manager for 30 plus years. My daughter reminds me that it's not cool to talk about 30 plus. She's now hitting 34. And I started back in 86 in Southern Life, so I've seen a few market crashes in my time. And I think it's really important for you to walk away tonight feeling that there's a level of common sense and simplicity in how I go about selecting the funds. We're going to talk a bit about your current fund, and I'll share with you what I've invested in. And then I really want to take you through 7 or 8 themes that I think will shape the future of the investment environment. In my 30 years experience, the current environment is particularly dynamic, and it's very obvious that companies and countries that are coping very well with the process of change are succeeding and those that aren't are failing. But I thought I would just start off with a little sanity check. Paul Samuelson, a great economist, wrote in 1947, "Perhaps there really are managers who can outperform the market consistently. Logic would suggest that they exist, but they are remarkably well hidden." I think the industry that I'm part of needs to take a long, hard look at itself in terms of the promise made to clients about this constant delivery of outperformance, and really unpack, which we are going to do tonight, in much greater detail how that performance is achieved. Just by way of introduction, the fund that I have the pleasure of managing on your behalf is a global multi-asset flexible fund. I have the freedom to invest in different assets. The objective, obviously, to achieve long-term capital appreciation. The benchmark is quite demanding. It's equity-oriented. 85% of the MSCI, that is the Morgan Stanley All-Country World Index. To give you a sense, there are about 1,400 companies that I can choose from. 15% US dollars, 5% cash, and I've managed the fund since inception. That's the performance of your fund versus the peer group over the past 3 years. Sitting at the back earlier, I noticed that the numbers were a bit small, so I'll read them out to you. The peer average has done 13.5. Your fund has delivered 32.5. So nearly 3 times the peer average. And since inception, nearly double the peer average. So you're up 99.2% versus the peer average of 54. What I like about the slide is that there is a consistency of return. I'm very conservative in nature. I trained as an accountant. I am partially rehabilitated, with apologies to all accountants in the room. And I started a journey in accounting where my audit partner, Jack Zeller, I think instilled in me some of the foundational elements that have come through into my quite conservative investment style. And that was that he imparted one gem of information to me. And he said, all accountants would like you to believe that what they're publishing is the truth. My job is to show you how to uncover the truth. And we used to do things like walkabouts. And then he would sit me down and say, I can read the financials, but you tell me what you see. and with the hairs on the back of my neck standing up, I would try and enunciate to Jack Zeller what it was that I saw on Walkabout. And then he would say to me, Tony, that's very good. When I come back in 3 weeks and you finish the audit, I hope you also saw what I saw. So with reference to Steinhoff, African Bank, Tongaat, the list goes on and on these days. There's a certain somethingness that goes beyond the numbers that makes you want to dig a little deeper into the companies to see if you can see the picture. And if you can see the picture, you can see how the picture changes. And that's what I'll unpack for you tonight. So a nice set of numbers. I'm very pleased with the performance. I'm not very big one for accolades. Magnus asked me to put them on the slide. There they are. They're raging bulls. I'm not a raging bull, even though I am Taurian. I like to be quiet and conservative in the background and just make good investment calls. Where's the performance come from? What this slide shows you is every single stock we have held in your portfolio. The vertical line is how well the stock has done, and then the horizontal line is how much it has contributed to that overall outperformance of your fund. By far the standout winner is Amazon. I remember having to write a brief for a client at $275 why I even had Amazon in the portfolio. Did I not know it was expensive? Today it trades at about $1,800 a share. MasterCard, Visa, and Adobe have done very well. And then there's a cluster of high-quality stocks, the Apples, the Microsofts, which we'll unpack in more detail. And for the gold bugs in the room, yes, the fourth largest holding in the fund at the moment is Barrick Gold, and it is up 30% in the last month. Over the period, it was a little bit of a laggard. What you'll also see unpacked in the presentation is the shape of the portfolio is very balanced. There are no particularly big bets in the portfolio, because what I like to do is I like to pair different exposures to different sectors. So MasterCard, Visa, PayPal go together. Adobe goes together quite nicely with Microsoft. Amazon is a little bit of a unique opportunity. The other thing that you see in the slide is that there are very few stocks down here. I think one of the things that is understated in the investment world is the management and the importance of the management of risk. We are not good enough as investment professionals to stand before you and say, with any degree of certainty, we know what the winners will be a year from now, 3 years from now, or 5 years from now. What I think we can do to the best of our ability is manage downside risk. And a lot of alpha, a lot of excess returns come from how well you manage downside risk. It's not about the ability to pick the Amazon of the future. If I stood here today and I said, for certainty, I know what the winning stock for the next 5 years is going to be, I may as well put 100% of your portfolio in and walk away. The simple reality is, I don't know, other people don't know, and it's a little bit of an illusion to think that we can know that. So what I do is I'm going to unpack with you tonight how I try and bias the portfolio towards the winners, but very importantly, how I manage risks to the downside. When a stock is not painting or conforming to the picture that's been painted, what is changing within the stock? What happens to that company, like a recent example being Facebook, where suddenly there were start of rumors around data integrity, younger folks started to leave Facebook, the market became a little uncomfortable. The same is happening at the moment with Google, and I'll unpack how I go into that and manage it. Your portfolio at the moment has a nice spread. I've just listed for interest's sake the exposure per sector. These are the main sectors listed on the MSCI. There are 11 of them in total. And these should be names that are familiar to you. You shouldn't ever receive a fact sheet or portfolio update where you think to yourself, gee, that's an unusual name. There are over 1,300 stocks to choose from. In South Africa, you've got 2 or 3 medical hospitals. Overseas, I've got 26 medical pharmaceutical companies to choose from. In South Africa, you've got 4 or 5 banks. I literally have hundreds to choose from. So the playing field internationally, as we will go through in a moment, is quite vast. I tend to take relatively small positions. I spread the bets across the portfolio. You will always see around 35 to 40 stocks in the portfolio, and you'll never see excessive exposure in any one stock. So the perennial question that gets asked is, where does this mythical thing called alpha or excess return come from? And I'm going to unpack that for you in 2 slides. I also want to share with you the framework that I use in looking at companies and trying to decide, will it be a good investment? We're going to go through some of the changes in this global landscape that are impacting the investment world, and then how we manage the drawdown risk. In 30 years, I've pondered the problem, where do excess returns come from? And there are only 3 places I've found them. And they're very simple to articulate. When earnings goes up, when earnings growth of companies accelerate, the share prices do well. When earnings growth of companies do poorly, the share prices do poorly. And on occasion, you get a big bear market in equities where the value of the company really does dislocate from the price. So with that as a background, what do I spend a large proportion of my time doing? I try and manage, first and foremost, not having these stocks in the portfolio. So I probably spend more than 60-65% of my time looking at avoiding loss. That's rule number 1. Rule number 2 is I spend quite a lot of time asking myself, how might the earnings growth of a company improve? It's a very, very difficult question to answer because you have to go beyond what the market already expects from a company. Analysts' jobs are to forecast earnings. They're called consensus forward earnings. Those earnings gaps can be quite wide. A lot of investment professionals rely on those consensus earnings, but you've got to go beyond the numbers to understand how the earnings growth of a company might improve or decline. So alpha comes from 3 places: having more of these stocks, having less of these stocks, and on occasion, when markets do come a little unglued, being brave enough to take the opportunities that the market presents. If we have a look at different economic cycles, the slide that might interest Mike, the orangey, and apologies for those in the room that are more color conscious, I'm a bit colorblind. The orangey part denotes the proportion of return that's made up by earnings through the different cycles. So the simple way to read it is when you're in the early stages of a recovery, stock markets do well, earnings make up a big proportion. When you're in the mid phase of a recovery, markets do well, earnings make up a big proportion. Where we are at the moment, late phase, it all gets a bit crunchy. So it's much harder to differentiate between the good companies and the bad companies because earnings are not as impacted. But when we go into recession, earnings make up a really big portion of why companies perform poorly. So if I can just get one thing right, and that is forward-looking assessment of what the potential for a company's earnings growth will be into the future, I'm halfway there. If we look at the landscape, that came out a bit funny, but we'll talk to it. if we look at the landscape, it's a very rich environment to select stocks. The purpose of the slide is just to give you a sense and a feel. If we take the S&P 500, by far the biggest sector is information technology, followed by healthcare, financials, consumer discretionary, and industrials. But if we strip out the top 5 in each sector, you'll see that the picture changes quite a bit. Consumer services comes from there to number 2. And the reason for that is that the global landscape is dominated by certain very large companies. So what I've tried to represent on this particular slide, I've taken all the companies together and I've showed you in the solid line how profitable all the companies put together in every sector are. And then I've stripped out the top 5. That's the dotted line. And you can see in certain sectors, the top 5 appreciably dominate the sector. That makes my job a little bit easier because I can then look at the top 5 companies and say, which of these do I want to pick? And then which do I pair it with? So Microsoft goes very nicely with lesser order tech companies like Intuit, or at a more logical level, Visa and MasterCard pair nicely with PayPal. Back in Seifried's days, when I was the CIO at Seifried's, I discovered that analysts are very predisposed towards running valuation models. That's how we trained. So we trained as accountants. That's how the CFA degree trains us. And somehow the numbers, for me, weren't the starting point. It wasn't the logical place to start with looking at a company. Because it's pretty easy to start off with a spreadsheet and you say, well, how much is a company's turnover going to grow by? 5%, 8%, 10%. We're human. We get into a behavioral bias. There are just too many variables to get wrong in that forecast. So I hope it doesn't shock you too much, but I don't spend a lot of time running Excel spreadsheets on valuing companies. I spend an awful lot of time looking at these particular factors. I want to understand the industry in great detail. What is happening in the industry? Let's park that for a moment because we're going to go through 7 key drivers that are going to change part of the world that we know it today and have a massive influence on companies in the future, and that will illustrate what I'm talking about with industry. But I also want to dig into the company and say, what's this company about? The X factor. Do they have something that's a little different, a little unique? So for those of you that might have children who are, or yourself, involved in the graphic design industry, Photoshop, Adobe InDesign, Illustrator, absolutely captive in their space. Microsoft Office, believe it or not, is still unparalleled. So I want to try and understand what it is that the company can hang on to that will underpin its earnings. Brand value is not really about the Nike symbol or the Starbucks coffee logo. It really is about understanding monopoly, pricing power, and trade secrets. The more a company has of those inputs, the more it tends to protect its brand identity. The power law is fairly easy: position, product, price, and people. And then for me, the key is how you put 1, 2, 3, and 4 together through a distribution structure that allows the company to leverage up its earnings. And Mike spoke earlier of cash flow. Accountants can represent any number of numbers of earnings. I think with no particular reference to discovery, which is quite close to home. There are now 26 different expressions of earnings per share. Which one would you like to pick? I only look at one: cash equivalent earnings per share. So in my analysis, I convert everything into cash equivalent: the income statement, the balance sheet, cash flows. Cash doesn't lie. If you want to find out why most of these companies go Pear-shaped, just follow the cash. As Jack taught me, the cash doesn't lie, and if you follow the cash, the accounting manipulation becomes less of an issue. So for me, in terms of understanding how the earnings growth vector of a company will change, these 7 factors, or the first 6, are absolutely key. What I find when I interrogate and I discuss and I debate the issue with most analysts is they haven't really articulated these 6 factors, and they don't really have a view because they've spent too much time modeling. And modeling is fraught with all sorts of errors. If you popped along to Ian Moore at Woolworths at the moment and you asked him what his profits are going to look like in 3 years' time, his honest answer would be, I'd love it if I knew that, but I don't know. And yet there's an intellectual arrogance within the investment community because we forecast these things 5 years into the future, we then assume a terminal growth rate, and we come up with what we think the share price is worth. I tried that for a long time, 15 odd years, and then I worked out that the market's much better at doing it than I am. So what I tend to do is I tend to try and understand the picture that the market is painting for me of the macroeconomic environment through the currency markets, through the bond markets, and in every single share price. Try and understand what this picture looks like for every one of the companies that I'm invested in, and then monitor to see how that picture's changing. You have a very different discussion with yourself. So for the last 7 slides, I thought it might be nice just to take you on a little bit of a journey. We have roughly 35 stocks in the portfolio. The question I ask myself is, how well are those companies going to cope with the world as it is changing at the moment? Observation number 1. This is research that I've drawn from Ernst & Young. Industries are changing quite quickly. So as an example, we have in the bottom block over here 4 Indian telecom companies that were granted banking licenses. For many of you that follow Facebook, they want to get involved in cryptocurrencies. Apple wants to become a bank. Who knows what Amazon's going to be next? My guess is they're probably going to go into pharmaceutical distribution and the like. So the whole use of technology is changing the way industries position themselves very, very rapidly. As an example, you go back to 1996. The big companies were all the telecommunication companies. Today, those telecommunication companies are about 6%. Technology companies, which we're very familiar with, Alibaba, Tencent, have grown from 3 to 24. How do you think the earnings growth maps? I'm astounded when I get off the plane and I travel. We're all on our cell phones all the time. Vodacom and MTN are not making a huge amount of cash. Tencent is. They're in gaming. The other guys are trying to sell data at ever cheaper prices. The future astounds me in terms of how smart it is. When you have a look at the number of devices that are out there, we're kind of sitting 2018, we're about there. Mike can correct me, but that's more devices than there are people on the planet. And everything in future, I, being a conservative manager also, as you would expect, drive a Volvo. And when I went to pick my Volvo up the other day, I waited for over an hour and a half because they had an internet problem. What does servicing your Volvo have to do with the internet? Well, they were doing software upgrades. So I can quite easily foresee in the future when I park my Volvo into my garage, it will say to me, connecting to your Wi-Fi, software upgrade downloading. This is the most profound change we've seen in a very long time. The future of work is changing, very much so. So Intuit predict, for example, that 40% of workers will, in the very near future, by 2020, that's next year, start to contract out as opposed to be employed. This one's a little bit scary. The World Economic Forum estimates that a confluence of technological, socio-economic, and demographic drivers will displace, should have been in capital, 5.1 million jobs across 15 major economies by 2020. So not only is the job landscape changing. When I matriculated far too long ago, you had to become a lawyer, a doctor, an accountant, or something similar to earn a decent living. The world is somewhat different now. To place that number in perspective, the global financial crisis of 2008-2009 shed about 2.7 million jobs. If you look at the whole technology around driverless, the single biggest class of employer in the US is male truck drivers, 4.5 million of them. What happens to them if the technology starts to take over? I don't know, but it does occupy my mind. If you have a look at the behavioral revolution, we're all familiar with climate change, we're familiar with chronic disease, and it is shaping the environment around us. It is opportunistic for certain companies. I'm interested in how companies are addressing the opportunity. For the doctors in the room, I am intrigued with companies like Intuitive Surgical, Intellia Therapeutics, the work that's being done on the CRISPR-Cas9 system. Morality of it aside, it's very interesting technology. I do have a few biases. I won't invest in Bayer because they own Monsanto. And so there's a part of me that says I'm not prepared to commit money to companies that may or may not be subject to future litigation risk because of the products that they put out into the market. So that's my contribution to ESG, if you like. I exercise a little bit of a social and governance override. I also, while I'm on the subject, do not invest in companies the names of which I do not like or can't understand, and management of which I do not trust. I learned a long time ago, for many of you in the room, you might remember Profern. You might remember Corp Capital. In fact, one of the building that we're in has got a certain history attached to it. As I recall, the data hit 77 Rand and it bottomed out at about 1.50 Rand. I think most people in the room are old enough to remember that. Sometimes it's not just about the numbers. There's a real sense that you've got to go beyond what the broker reports and the numbers are telling you, and you've got to think and apply some common sense to how one goes about rationally investing in companies and make sure that you follow that quite closely. We're all becoming a lot more empowered. I don't know how many of you do it, but I certainly do, and I'm 58 years old. You do your research. By the time you walk in to buy something, you're expecting an experience, not an information download. You've done your information gathering. You've compared products. You've shopped online. You've gone on to Takealot. You've gone on to Amazon. You've understood what the comparative pricing is. Imagine the threat to retail operators, for example, when Amazon already has the technology where they can offer you a price right now for a product that you're interested in based on AI's interpretation of your buying history. But that price is only available to you if you choose to buy now. How does a Walmart compete with that? How do the other major manufacturers compete with that? It really is problematic. By the way, while we're on the subject of Amazon, it is no longer a profitable retail company. In fact, if they had to split it up, it would be one of the world's most unprofitable retailers. It exists purely because of Amazon Web Services. And as an interesting example of how I go about my thinking, what got me into Amazon? It wasn't the retail. It was that there was $4 billion of free cash flow every year that I couldn't trace through the income statement or balance sheet. Bezos was so clever. He hid this thing so well. What he was doing was he was busy building Amazon Web Services under the radar screen. And the only way we picked it up was I started to look at every expense item, and I saw how that expense item was changing in relation to retail sales. And if you go back in history, Amazon only declared separation of Amazon Web Services, the cloud business, back in 2017. Prior to that, it was a bit of a mystery. And he'd written it all to data service costs. Very clever guy. So that's an example of that. Second last slide. The world around us is changing. I was born in 1960. In 1970, there were 2 megacities. Today, there are 23. Maybe South Africa is going to build one, I'm not sure. But 41 by 2030. It's an extraordinary change in the landscape. How do companies cope with that? And then lastly, for the physicians in the room, I'm sure this needs no introduction. We're going into a world where chronic health is a major issue. There's a lot of opportunity. There'll be a lot of data collected to create better diagnostics, but the technology itself is reimagining the health service industry for the future. So how do companies deal with this? And that's, ladies and gentlemen, what I spend a great deal of my time with. So in summary, 3 real things. My preoccupation was really in understanding companies as best as I can, with a view to examining the integrity of the company, the sort of strategic thinking, the management integrity, and the basic component parts that go into making a company work, and then understanding how realistically those component parts can work together to change the earnings profile of the company. If I can get that right, I stand the chance of being able to pick the future successful investments. But what I'd like to leave you with tonight is that my preoccupation is really about managing drawdown risk in your portfolio. Because if I can manage the drawdown risk very actively, the upside tends to take care of itself. On that note, thank you very much for your time. I'll hand over to Sam Hurley and we can take questions later.